Hello students, welcome back to the series of economics, National Income Made Easy. So in the last video, we have covered a very important topic, that is circular flow of income. I hope that topic is clear to everyone. But if you have any doubts or queries, you can comment it on our chat box. So now we are going to start with the next topic, that is our video 2, Basic Concepts of Macroeconomics. In this video, we are going to study and get familiar with different terminologies which are going to be very essential to understand the chapter National Income Accounting. Like for the first one, it is domestic territory. In a very simple sense or in a very layman language, domestic territory, by this we usually mean the political frontier. That means the boundaries which are covering to us. We are standing within that boundary. We are freely moving goods, services, people, money and so on within that boundary. So usually by the term geographical boundary or domestic territory, we means that particular boundary. So in this given picture, you can very clearly see that this is the boundary. It is nothing but the boundary, and inside which there is a person standing. So basically the boundary within which people, money, goods and services can flow freely without any restrictions is nothing but your domestic territory. So let us read over here. According to the United Nations, economic territory or domestic territory is the geographical territory administered by the government within which a person, goods and capital circulate freely. So this is nothing but the boundary or the territory within which person, goods, services or money can freely circulate within the territory, within the boundary. This is nothing but domestic territory. Then they say that in addition to the political frontiers, domestic territory also includes. Now, what will be included under domestic territories? So, first, ships and aircrafts owned and operated by a normal resident between two or more countries. So, first and the foremost thing which will be considered under the domestic territory is the ships or the aircrafts which are owned and operated by the normal resident. What do we mean by normal resident here? So, normal resident is the person belonging to that particular country. For example, there is a ship or the aircraft which is owned by an Indian person, but that ship is traveling between two different countries. But still that ship will be the part of our domestic country because that ship has been owned by the person who is residing inside our country. So resident is basically nothing but the person who lives in our country. So even if there is a transfer of ship or ship is basically transferring goods and services between two countries, say suppose India and Japan, still that boat will be considered our domestic territory because that boat has been owned and controlled by an Indian person. So this ships and aircraft will become the part of domestic territory. Secondly, fishing vessels. What are vessels basically? Vessels are nothing but the boats and ships which are used for the fishing purposes. So, fishing vessels, oil and natural gas rigs. What are rigs here? Rigs means nothing but containers. Containers of oil and natural gas. We know that oil and natural gas are these things which are highly inflammable. So, we have to keep it in a proper container. So, those are nothing but rigs. then floating platforms operated by the resident of a country in the international waters. So, for example, if there is a fishing vessel which is traveling from India to USA in the international water, that water becomes international since it is going to outside our country, some other country. So, anything which is flowing in international water but belongs to the Indian person or an Indian institution, it will be the part of our domestic territory. And third is embassies. For what is embassies first of all? So embassies are nothing but the association which represent one country in another country. For example, USA. We know that in this country there are lots of Indian people residing. Yes. So now who will be solving any queries, doubts or problem of these Indian people? So for that, in USA there will be an association of people who will be belonging from our country, from India. They are from India and they are settled over there as the representative of our country. So if any Indian in USA faces any kind of problems or if they have any doubts, they can directly go to the Indian embassy which is situated in USA. Now, although it is situated in USA, but that will be the part of our territory. That will be considered as the part of domestic territory. Okay. Then we have consulates. Consulates means government offices. Say suppose there is any government official who has been sent to the foreign country for the work purpose. So that person will be called as consul, and the place where he is occupying, where he is sitting, is nothing but consulate. So even the place where he is sitting will be the part of our domestic territory. For say there is an Indian person who is visiting to USA for some work purpose and he is a government official. So in that case, the place where he is occupying in USA will be still considered as the part of our territory, that is domestic territory. Then you have military establishments. Military establishments, especially if you know army people, they have their camps in anywhere possible, in any part of the region, in any part of the country. So if say suppose there is an Indian army who is going to Nepal for any kind of camping or any kind of workshop, seminars or for any activities say suppose, then still the establishment which Indian people have done in the borders of Nepal or in the place of Nepal, that will be again considered as our domestic territory. That will be coming under Indian domestic boundaries or Indian domestic territory of a country located in abroad. So all these things, apart from people, goods and services, money, ships, aircrafts, water vessels, boating vessels, oil and natural gas rigs, embassies, consulates, all these become the part of domestic territory. We also call it as economic territory, geographical territory, political frontiers. Next, we also have to see that domestic territory will not include what all things. We saw what things are included. Now we will see what things are not included. So first, embassies, consulates and military establishments of a foreign country. Now we said that we have our Indian embassy in different parts of the world, in different parts of the country. For say suppose we have Indian embassy in Russia, in China, in Japan. So same way, those countries will also have their embassies in our country in India. So say suppose in India there is an embassy of USA, of China, of Russia. So now they will be calling it as their domestic territory. We cannot call it as our domestic territory because we have already said that our Indian embassy, wherever it is situated in the part of the world, that part will come under our domestic territory. Same way, other countries will also say that if we have our embassies, consulates or military establishments in your country, then that will become our domestic territory. Second, international organizations like UNO, WHO, etc. located within the geographical boundaries of a country. So, if this is your geographical boundary, that is, if this is your country, India, but there are some international organizations like UNO, WHO, they are situated within the geographical boundaries, but still they will be not considered as our domestic territory. Here, our means our country, India. Those things, those organizations will be considered as the organizations or domestic territory of international countries. Fine. Let us move towards a second term, that is normal resident. So, who is a normal resident now? Normal resident is a person who resides within the geographical territory, within the country, who lives in that particular country. So, normal resident of a country refers to an individual or an institution who ordinarily resides in the country and whose center of economic interest also lies in that country. So, here again in the picture we can very clearly see that this is our domestic territory or geographical boundary, India. We have households, we have people, we have institutions and firms which are situated within the domestic territory. So, all these things will be considered as the normal resident of the country. Remember, a normal resident can be an individual person or else it can also be an institution. So, all of these things, people, institution, firms, households residing within the geographical territories and carrying out all the economic interest within the geographical territory will be called as a normal resident of the country. Now, here we are seeing a term economic interest. What is economic interest? Economic interest means the person is doing all his economic activity. Person is performing all the economic activity within that geographical boundary. All the economic activities like he is earning in that within the geographical boundary, he is paying his expenses within that, he is paying taxes and within that. When people or institution does these kind of activities, they are considered as the normal resident of country. So here that is why in the picture we have shown that how people residing within the country and completing all their economic activities within the country, they will be termed as normal resident of the country. The normal resident can be an individual, it can be an institution, firm, households or anything. So the second term is normal resident of the country. Next term is citizenship. I am the citizen of India? Yes, definitely I am. Because I have taken birth in this country. I have born in this country. Yes? So that is why I will be termed as citizen of the country. I have citizenship of the country India. So it is basically a legal concept. Legal concept means law. It is by law. Okay? Based on the place of birth of the person or some legal provision allowing a person to become a citizen. Okay? So, by two ways you can be considered as the citizen of the country. First, when a person is born in India, he automatically gets the citizenship of India. So, since I am born in India, my citizenship is been active automatically. I don't have to do anything for that. Just because I have taken birth in India, I will be the citizen of this country. Or secondly, by a person outside India applies for the citizenship and Indian law allows him to become an Indian citizen. So in that case also the person can be called as a citizen of India. Example, there is a person who is coming from USA to India and he has applied to the Indian law that I want the citizenship of your country. That means I want a citizenship of India. After doing all the due and diligence, the government of India will take a decision and give him the citizenship of country. So, by two ways you can become the citizen of India. First, if you take birth in the country, you automatically become the citizen of the country. Secondly, by law. If you are applying to the government of India for the citizenship, if government of India is clarified and clear with all its procedures, documentation, they might give you the citizenship of the country. Okay. So, that is nothing but citizenship. It's a law concept. It's a legal concept. So, in this picture also you can very clearly see that the person can become a citizen of the country in two ways. First, by birth, if he is taking birth in that country. Second, by Indian law. If government of India, if the law is giving him the permission to become the citizen of the country. Next term comes is residentship. Do not get confused between citizenship and residentship. They are very different from each other. Both the terms are extremely different from each other. Okay. By any ways, they are not at all same. So, let us see what is a residentship. So, this is an economic concept. Under citizenship, we said it is a law concept, it is a legal concept. Same way, residentship is an economic concept based on the basic economic activities performed by a person. So, residentship focuses more on the economic activities of the person. An individual is a normal resident of the country if he ordinarily resides in the country for a period more than 1 year. His center of economic interest also lies in that country. Yes, if the person lives in a country for more than 1 year, he will be considered as the resident of the country, because now it's almost been 1 year that person is performing all his economic interest under that country. So, he will be considered as the resident of country. Okay, but if say suppose this is India, this is USA, and US tourist has come to India for visiting India for say suppose for 2 months, then will he be called as a resident of the country? No, because he is here for only 2 months, he will be leaving the country very soon. But if he is in the country for more than 1 year, he might be then considered as the resident of the country. Example, a Chinese living in India for more than 1 year is normal resident of India. Why? Because his economic interest is lying in our country for more than 1 year. Economic interest is nothing but the economic activities. That means earning income, paying taxes, doing all its expenses in the country. However, he is not citizen of India as he does not hold citizenship of India. So, if that person is in India for more than 1 year, we might call him the resident of India, but still we will not give him citizenship of India. Why? Because he is here, he has not taken birth in our country and he has not even applied for citizenship in the government of India. So, that is why that person can be called as the resident of India, but not the citizen of India. It means a person can be citizen of one country and at the same time a resident of another country. So, the person who is coming from China in India, he is the resident, Where else in China? He is the citizen of China. So, a person at the same time can be a resident of one country and the citizen of another country. So, that is the concept of residentship. Next comes factor income. So, what are factor income? Income received from factors of production are called as factor income. We already know what are factors of production: land, labor, capital, and entrepreneur. These are nothing but factors of production, major factors of production. And the income received to these factors of production in the form of factor payment or factor income is called as nothing but factor income. So, wages and salaries, rent, profit and interest together form the concept of factor income. So, let us give a read. Factor income refers to income received by factors of production for rendering different services in the production process. It is received for providing factor services like land, labor, capital and enterprise. Factor income of normal resident of a country is included in national income. We also know that this factor income received by normal resident of the country will be included under national income. So, example is rent, wages, interest and profit. Together, they form the concept of factor income. Next, transfer income. Vast difference between factor income and transfer income. Factor income is the income which the households are going to receive after providing their services. But transfer income is something, some kind of income which we are receiving without providing our services. Confused? Let us see what transfer income is. So, transfer income refers to income received without rendering any productive services in return. It is a unilateral concept, that is a one-sided concept. A and B. A is providing no goods, no services to B. But B is giving some kind of money to A. So, this money is nothing but an income for A. But why A is receiving this income? A has not provided any goods and services or anything to B. Still, he is receiving some kind of income. So, such kind of incomes are called as transfer incomes. So, the example can be pocket money. Your parents give you pocket money, 10 rupees, 100 rupees, 500 rupees, whatever it could be. So, when your parents give you pocket money, are they expecting any kind of goods or services from you? Or are you going to provide any kind of goods and services to them? No. But still you are receiving the pocket money and that's an income. So, such kind of incomes are called as transfer incomes. Best example is pension fund. Pension. This is something which we usually give to old people. Since they are now not able to provide their services and work in the organization, government will provide them some kind of money, which is called as pension fund. It is not included in national income as it does not reflect any production of goods and services. So, as we said, transfer income is received without rendering any kind of goods and services, right? So, that means there is no kind of productive activity taking place in the economy, but still the income is being received by the person. So, such kind of activities are called as unilateral activities or one-sided activities, wherein the person is not providing any kind of goods or services, but still receiving some kind of income. So, these are called as transfer incomes, and income received without providing any goods and services in the economy will never be included in the concept of national income. Whereas, factor income which is been received after providing the goods and services to the economy, that kind of income will be considered under national income. So remember this point, very important. Factor incomes are always included in national income, but transfer incomes are never included in national income. So it can be received within the domestic territory of a country or from abroad. So for say suppose India, Russia. In Russia, you have a relative. That relative is sending some kind of money to you where you are and you are sitting in India. Without any providing goods and services, the relative is sending some money for you in the form of gift. So this gift is nothing but your transfer income, because you haven't provided any goods or services to that person, but still you are receiving some kind of income. So this income is nothing but your transfer income, and or unilateral also, because only there is one side money. From here nothing is going, only from Russia it is coming, from India nothing is going over there. So they are called as unilateral concept or one-sided concept, and this can be happened within the domestic territory. It can be happened outside the domestic territory between two different countries. Example of it is old age pension, scholarship, unemployment allowance, pocket money, etc. Next, final goods. What are final goods now? So, final goods refers to those goods which are used for consumption or for investments. Final goods are basically those goods which will be used for investment purposes or else for consumption purposes. Example can be furniture, chips, chocolates, etc. You are purchasing furniture as an investment, or you are purchasing chips and consuming those chips. So basically final goods are those goods which are ready to use, and it is up to the buyer that whether he wants to invest in those goods or whether he wants to consume that good. So it can be used for consumption or for investment. And here you can directly see the example of final goods. You have a chair, the packet of chips, then you have chocolates. These are all the example of final goods wherein the person can invest or either the person can consume. Intermediate goods. The next terminology is intermediate goods. With the name itself, we should understand that these are the goods which are not ready to use by the consumer. Intermediate goods refers to those goods which are used either for resale or for further production in the same year. So, intermediate goods are those goods which can be used for resale or else further production in the year. For further production process of goods and services, we might use those goods. Examples are machines, equipments and tools. So for say suppose I want to produce coffee. For this I would need a coffee machine. So from this machine I am getting a cup of coffee. So that means this machine is my intermediate good because it is helping me to produce cups of coffee, and the cup of coffee is nothing but my final good. Very easy. So intermediate goods are those goods which are going to be needed for further production process of goods and services. Final goods are those goods which are ready to consume by the consumer. So see here, if I want to make a shirt which is my final good, for making this shirt I will be requiring different kinds of intermediate goods. So cloth material, scissors, sewing machine, all of these will be considered as my intermediate goods since they are helping me to produce shirts. That is my final goods. So here you can see intermediate goods and here you can finally see the final good. The person cannot consume sewing machine, scissors or clothes, no. He will have to buy a shirt if he wants to wear a shirt. So, intermediate goods will help in production process of final goods. So, these are refers to goods which satisfy the wants of consumers directly. Directly the consumer can go, buy it and consume it. Example is bread, butter, shirt, pen, television, furniture, etc. So, all these are the examples of your consumption goods wherein the consumer can directly go to the market, purchase those goods, come back and consume those goods. Next term, capital goods. So, these are final goods which help in production of other goods and services. Example is plant and machinery, equipments, etc. So, these are the final goods which are going to basically help in the production of goods and services. The example can be a sewing machine. Next very important term, gross investment. Gross over means nothing but original value, is nothing but investment. For example, I want to invest my money in the machinery. The cost of the machinery or the price of machinery is 20,000 rupees. So, this 20,000 is the price at which I have invested on a machinery. So, this 20,000 is the nothing but gross value of investment or gross amount. The original amount without any deductions of depreciation, taxes or anything, the original value at which the good has been purchased or on which the investment has been made is called as gross investment. So, in the addition to the stock of capital before making allowance for depreciation. Before we deduct depreciation, the original value is called as gross value. Capital stock consists of fixed assets and unsold stock. So, if we talk about capital stock, it means the fixed assets like machineries, land, building, etc. and the unsold stock, the stock which has been kept still in the inventories. So, gross investment is the expenditure on purchase of fixed assets and unsold stock during the accounting year. We know what is accounting year. It is nothing but your financial year or fiscal year, which is from 1st April to 31st March. So, within this period, the amount invested in the capital stock in the form of fixed asset or unsold stock is called as gross investment before making any kind of deductions. So, that was your gross investment. Now, we come to the next term, that is net investments. Net means what? Net means after doing the deductions, the value which is left is called as net value. For example, the salary of person is 1000 rupees, less we are deducting the tax 200 rupees. The amount left in the hand of the person is 800 rupees. So, this 1000 rupees will be considered as gross value and this 800 rupees will be considered as net value. So, net value means after doing the deductions, after making the deductions, how much amount of money is still left in your hands. That is nothing but net value. So, the actual addition made to the stock of economy in a given period is termed as net investment. Formula for net investment is gross investment minus depreciation. So, the original value at which you are making an investment is called as gross, and after making an investment there are going to be certain kind of deduction, mostly depreciation. After doing the depreciation, how much value is left is called as net value. What is depreciation? That also we will see right now. So, see, the next term is depreciation. Depreciation refers to fall in the value of fixed assets due to normal wear and tear. passage of time or expected obsolescence, changes in technology. So, any fixed asset on which you are investing, after certain period of time, the value of that fixed asset will start reducing. Why? Because of wear and tear of that commodity, wear and tear of that fixed assets, or might be due to the obsolescence of that particular technology. For example, earlier we used to prefer computers, but now at present we have so many different options like laptops, Mac Pro, and so many different things you have, right? So now people will prefer for laptops and tabs and everything. People will not go for computers. So here computer is becoming obsolete, and that is why the value of computer will start depreciating. Same way, if there is any fixed asset for, say, suppose a machinery which you have purchased for 20,000. After 2 years, if you want to sell this machinery, will it go for still 20,000 or will it go for more than that? No. It might go for 15,000. 5,000 because you have used that machinery already for 2 years. For 2 years, you have already used that machinery. The wear and tear of that machinery has already happened. So, that is why the value of that machinery will reduce. And that is what is called as depreciation. Next, very important is NIT. This is nothing but net indirect taxes. This is nothing but difference between indirect tax and subsidies. So, the formula of NIT is IT minus subsidies. So, what is IT and subsidies? NIT has two major components, IT and subsidies. Your indirect tax are nothing but GST, that is goods and services tax. So, these are the taxes which are imposed by the government on production and sale of goods and services. So, the taxes which are imposed on the production of goods and services on the sellers during the sale of goods and services is called as indirect taxes. And second is subsidies. Subsidies are nothing but the things which are provided at some discounted value to the people. Okay, discounted value, discount. Basically, in a very layman language, you understand subsidies means nothing but discount given by the government. So, subsidies are economic assistance given by the government to the firms and households with a motive of general welfare. In India, LPG cylinder is sold at subsidized rate. That means it is sold at discounted rate. So, government of India provides LPG cylinder at discounted price. So, for say suppose the one cylinder cost is 600 rupees. I am taking just an example over here. So, that 600 government will make it subsidized for the people and start providing this one LPG cylinder for 500 rupees. So, usually government do this for the firms and the individuals for the economic welfare or general welfare of the people. So, that is very important, NIT. Next comes factor cost. This is nothing but factors of production. So, amount paid to factors of production for their contribution in the production process is called as factor cost. Now, people are providing their services to the organization, to the firm. They needs to be paid. So, land, labor, capital, enterprise. The total cost which the company or the organization has to bear for the production process, because to land we are going to pay rent, to labor we are going to pay wages, for capital we are going to pay interest, to entrepreneur we are going to pay profit. So this is a cost for the organization, right? Nothing but the cost, it's an expense for the organization. So this expense or this cost which is basically helping in the production process of goods and services are called as factor cost. Next, market price. Very simple. I hope you all know the difference between cost and price. Cost is the expense on which the organization is producing the product, and price at which the seller is going to sell the product. For example, to manufacture this one pen, I am a seller, I am a manufacturer, and to manufacture this one pen, I have to incur 20 rupees or I have to invest 20 rupees. Now tomorrow after manufacturing, I am going to sell this product in the market. Will I sell it for 20 rupees or less than 20 rupees? Never. I will always sell it more than 20 rupees because I want to or I have to cover my cost with earning profit, with the motive of earning profit. So, I will try to sell this same pen for 25 rupees. In this 25 rupees, I will be covering cost of 20 rupees and extra 5 rupees is going to be the profit for me. So, it refers to the price at which product is actually sold in the market. So, here you can see the market, here you can see various commodities, various products, and there is a price tag on every product. This is what market price is. Net factor income from abroad is again a very important term. It refers to the difference between factor income received from rest of the world and factor income paid to the rest of the world. Rest of the world is your nothing but foreign country. Okay. So, what you are paying to the foreign country and what you are receiving from the foreign country. Formula of NFIA is factor income earned from abroad minus factor income paid to abroad. So, we are receiving, we are paying. While we do export and import of goods and services, we indulge with rest of the world. So, factor income means, we have already seen, factor income means nothing but the income received by the factors of production. So, this income can be received from the other country, it can be paid to the other country. If you are taking services from other country, then you will have to do the payment, and if we are giving services to the other country, then we will have to receive factor income. Thank you for watching our video. For more updates, reach us on www.tgcampus.com or 1800-267-2677 or connect@tgcampus.com. Like and subscribe to our YouTube channel TG Campus In. Follow us on Instagram, Facebook and WhatsApp. Join our official Telegram channel TG Campus In. Chat with us on 8655682401.